Hey guys, Daniel here and welcome back to the Finance Channel. The stock market has been on a downtrend over the past few days here, and some people believe that this downtrend could continue over the next couple days or weeks as we continue to get back to realistic valuations on the Nasdaq. It seems like we're seeing kind of a rotation out of tech and into value plays, and that's making certain tech stocks go to undervalued valuations. And in this video, I have 15 stocks to either watch or buy during this correction that we're seeing here. So some of these stocks, I think there is something to say about buying already undervalued companies. Before this correction happened, I was mentioning a few companies that I thought were pretty decent deals. And I think there is something to be said about buying those companies that were already undervalued prior to this correction that are becoming even more undervalued now that the correction is taking place. So I've divided this up into two sections. One that had undervalued companies even before this correction happened, and the second half is going to be companies that, might still be a little rich when it comes to valuations. And for those, I'm really going to give some, kind of like buy targets and where I'm really looking at in terms of those. So stock number one on the list here, we have the Tattooed Chef. This is one I've been talking about a lot over the past few weeks here. I really like them. I think they're a great play in the vegetarian vegan space. Again, they're much cheaper valued than Beyond Meat. Already at a very cheap valuation prior to this correction that we've seen. And I mean, this is a stock that's been beaten down pretty heavily during this correction. I mean, just this morning, this was a stock trading under $19. So given that, I think it's a pretty decent investment, and I find it hard to believe that you'd be able to lose money on this over the next 5 years here, which makes it kind of intriguing from a possibly like 2-3 years out call options for this. That might be something I start to experiment if we continue to see the price stay stagnant after earnings. I see no reason why the stock shouldn't be trading well above $20 per share 3 to 5 years from now if they continue expanding and doing the things that they want to do. So stock number two we have Voyager Digital. Again, this is one that I don't really have to talk about. We've been talking about this so much on the channel here. This is a cryptocurrency play, a cryptocurrency trading platform. This is one that I really like. It's my biggest position, and I personally believe it's undervalued at these prices if we look at even just a 1 year scope. But again, this is a stock that's been pretty hit from this. I mean, just today it was down at around $11.50. So again, this is one that I like to buy on those bloody red days, like we saw this morning, down around 30% on the day. Absolutely huge. The next stock here, we have Shift Technologies, ticker symbol SFT. Again, this is a stock I've been talking about. It's one of my positions. It's been beaten down pretty heavily. I mean, this is a stock that I recommended at around 8. It went to around 10.50. Now it's at around that $9 range. They participate in kind of like the e-commerce used car market. I think they have a big TAM, total addressable market, over the next few years here. And I think it's a great way to play kind of that economy that's just kind of getting back there, somewhat slow. People aren't really buying new cars, and I think the used car market in general is gonna really explode over the next few years here as less people buy new cars. Like when you think about it, there isn't really a point in buying a new car as you're paying such a big premium to certain used cars, and Shift is at the forefront of benefiting from that. So next is Facebook. Again, I'm not going to talk about this one too much, but I made a video recently about how I believe Facebook could very well be a 3x stock over the next 5 years here if certain things play out. Again, this is one that's very resilient in this correction just because of how undervalued it was prior to it. So again, a lot of these undervalued plays, some of them are getting hit, some of them aren't. The ones that are getting hit are just becoming dirt cheap. That's kind of what I have to say there. Next, we have Dropbox. Again, this is a very stable play in the cloud space. I think this is, a stock that could possibly trade in around that $60, $70, maybe $80 range 5 years from now. Again, a very stable company, stable revenue growth, very profitable. I really like this one long term. Next, this one is new. This one's Corsair Gaming, trading at around $38.35. Again, this is one that's been on a downtrend even prior to kind of this correction that we saw here. 52-week high for this one is around $51.37 at around $38.35 per share. This company competes in kind of like the computer gaming space, gaming keyboards, gaming mouses, PCs, different components for PCs. kind of that space. I really recommend you going to Amazon, search up Corsair, and take a look at their products. Obviously very high quality, and they're in the top of their class when it comes to that. This is a company trading at around under a 21 forward price to earnings, which is very cheap given this is a high growth company. I mean, this is a company that grew revenues around 70% in 2020. And analysts have this company growing around like 8-9% next year, which I think is just laughable. I mean, I see no reason why this company shouldn't grow double digits next year, given their popularity and the continued expansion of the gaming industry. I think they're at the forefront of this, and I think this is one of the best plays in that space. So again, the more this one drops, just the more undervalued they become. I mean, under a 21 price to earnings or forward PE would be undervalued in a regular market. In this market where everything is super frothy, again, even more undervalued. Next here we have Callaway Golf, ticker symbol ELI. Now this one is very interesting as they are merging with Topgolf. Topgolf is an entertainment complex with like they have giant venues where you can go golf off of like mini balconies. Again, it's a very interesting place. Continued expansion of that. I think, Topgolf is the future, and it's really interesting as Topgolf was kind of possibly planning to go for an IPO. And that valuation was expected to be around $3 to $4 billion. So I think it's being valued around like $1 or $2 billion in this merger that they're completing here, which is a steal compared to what we would have had to pay for before. And with that package, you're obviously still getting Callaway Golf, which is a very profitable business. And again, they're a golf company, very stable growth, very profitable as well. And the golf industry, as we've seen this year, is just continuing to expand as time goes on. So here, that was kind of like the companies that were already deals before this correction happened. Now we've got companies that were kind of at frothy valuations. I wasn't really too interested in adding them because the valuations didn't really make sense. But because of this correction, valuations have come down, and if this correction continues, I think the valuations on a lot of these stocks could continue to go down, which is very good from a buyer's perspective. So stock number one here, we have Lemonade, ticker symbol LMND. I talked about this one last when it was trading at around $50 a share back in November. I really like this one long term. I might have to kind of reassess Lemonade when it comes from a fundamental perspective to kind of understand where they are, like pricing wise, where they are a deal. But I don't see myself adding Lemonade when it's above $100. I think there's too much risk with that, especially at such a large valuation compared to their revenue, which is pretty insignificant when it comes to like a ratio, like a price to sales. But I think if this one fell into under 100, it might be worth to take another look at Lemonade. Next stock here, we have Palantir Technologies. Now, this is a very interesting one, and stay tuned for a full fundamental analysis on Palantir in the future. This is a very high revenue growth company, around like 30% per year, very profitable. They have a lot of government contracts. They're in kind of like the data analytics space, being able to interpret different data, and the government obviously has a lot of contracts with them, which kind of speaks to the quality of their product and how good they are as a company and what they do. I mean, this is a company, I think they're projecting to do around $5 billion in revenue by 2025. So given that, I have to kind of reassess the situation. But again, this is one that trades lofty, but I think it always will trade lofty. So given that, I'm going to have to reassess the situation. I'll do a fundamental analysis within the next week or two, and we'll go from there. So next stock here, we have Pinterest. Now, I really like Pinterest. Just from a social media play perspective, I obviously really like Facebook. But I think Pinterest is a really great opportunity. They have a really great platform. I think the way they advertise fits in seamlessly, and I think the growth of their platform will continue as time goes on. Again, this is a company that growing revenues consistently, very high growth company, not trading at a crazy valuation, but obviously kind of this morning was a great chance to buy shares when it was around like that $70 range. Crazy how it went up, like, it fell, and then from that bottom it went up around 20%, which is just nuts. But if we see kind of a continued downtrend in the stock market, it wouldn't be surprising for me to see this stock go, below that $70 range. But that is if we see a larger pullback in the market. But again, expect a full fundamental analysis on Pinterest. So stay tuned for that. I really like this one. Next, we have Beyond Meat. Now, this is when I analyzed, again, back in like kind of that November time frame. I really like Beyond Meat. Now, I'm going to be honest with you guys. I like Tattooed Chef better because of their valuation. They have very similar growth. I think the Tattooed Chef is in a bit of a more niche market, meaning less competition, while Beyond Meat is in a more competitive landscape. With Beyond Meat, I can't see myself adding shares unless it's in that 120 range, which is very possible. I mean, Beyond Meat was in that 120 range just a couple months ago. So it would not surprise me whatsoever to see this one go back there. And I think that's the time where you add Beyond Meat. It has a lot of support around that $120, $130 range. I like that space because it gives me a price to sales of 20, which although is kind of rich, I think, again, Beyond Meat is one that will always trade rich because of the space it's in. But that's, again, one of the reasons why I like Tattooed Chef so much, because I think they're a disrespected stock that will get realized eventually. Next here, Shopify. Now, I think Shopify is an incredible company. They're in an incredible space. They're obviously best in their class in the e-commerce space. I think they'll be a competitor to Amazon over the next 10 years here. But again, this is one that I can't add over 1,000. It's just too rich of a valuation for me. Now, again, this you can make a very good argument that this one was overvalued even at under $1,000, but you also have to think to yourself, this is one that will always trade rich. And in my opinion, this is one that will trade, more rich than Amazon is now 10 years down the road. I mean, Amazon's trading at around like a 60 forward PE here today. So it wouldn't surprise me to see Shopify valued at kind of like that 100 price to earnings range. When it comes to the point where they're a very profitable company with giant revenues. But again, this is a growth company. You can't look at the numbers here today. You got to look at numbers 5-10 years out. So again, this is one that I have to analyze. I haven't analyzed any of these because of how high their valuations have been. But if these valuations start coming down and I see more opportunity in these stocks, I'll be making fundamental analysis on them. Next year is Teledoc. I talked about Teledoc a bit ago. I really like this one as a telehealth play. Again, stable revenue growth. I really like this merger with Livongo that they completed. Their powerhouse in the telehealth space now. I mean, at $256 per share, I can't see myself adding, but I think back my price targets or my buy targets back in that analysis video that I made are still valid here today. I think at under 200, it's, like okay, but it's really under that 280 mark, that I really like Teledoc rather. If it gets to 160, I like it even more, but I don't think that's too realistic given that's, a pretty significant drop from here today. But again, under 200, I kind of like this one, and under 180, I really like it. Yeah. So next year we have Tesla. Again, Tesla is a great company, significant revenue growth, great TAM. They're in the perfect space over the next few years here to dominate the electric car market. And I know a lot of people, don't like Tesla's valuation, but if you look 5 years out, I'm sorry, but it makes sense. 5 years out, I think Tesla is an undervalued company. They're at the forefront of the movement to electric vehicles, to solar panels. They're going to benefit very much from the Biden administration. And if this one continues falling, I mean, this one was at $620 here today, earlier today rather. So I mean, anytime this one's in the lower $600 range, if it falls back to the $500 range, I see more opportunity with this one. But there's no doubt in my mind that this one will be well above $1 trillion in market cap. Eventually down the road, a few years down the road, I think 5 years down the road, it could possibly be closer to a $2 trillion market cap. But a lot of it, depends on the autonomous taxi network and how quickly they get that rolled out. Because, the sooner they get that rolled out, that's very high profit revenue. So as soon as they get that rolled out, I think the valuation will adjust to the upside. Next year, this is one that I'm kind of iffy about, but I put it in here because it's one that a lot of people around here are talking about, and it's a very interesting stock. They participate in the sports streaming industry. So picture, NBA or NFL sports, right? And you pay a certain subscription fee and you get to watch those on demand or, on your phone or on your laptop, etc. Now, this is my main concern with this one is their profit margin, their gross profit. since they are paying a lot for their products. So I'm going to look into this one a little more. I would research this one heavily if you were to get involved in this one, as that is a big concern. But I'm going to look into this one over the next couple of weeks here. Again, there's a lot of stocks that I'm looking at, especially as the market continues to dip. This may be an interesting one, but yeah. So thank you guys so much for watching. I hope you appreciate this video. These stocks are ones that I'm watching. We'll see what happens with the market. I think this is kind of the market where you just got a dollar cost average in. We don't know how low this correction will go, but what we do know is that eventually we'll be higher than we are here today. I think this is going to be very similar to September, where it's, just a correction, just a reset. And I think it's very good for the market to take a breather, as it prevents the risk of a bubble, which a lot of people are talking about. So the more kind of corrections and stabilizations that we have in the market, the less risk there is of a possible dot-com crash. So I hope you guys enjoy this video. Thank you guys so much for watching. Smash that like button if you enjoy this type of content, and see you guys next time.